The best traders in the world make the smallest bets, and the worst traders never understand why. You probably think the path to a bigger account is making bigger trades. That's what it looks like from the outside. Someone doubles their money and you assume they were aggressive. They took big swings, they had conviction, and maybe that's true for one trade or 1 month. But here's what nobody tells you. The traders with the largest accounts didn't get there by betting big. They got there by betting small and never stopping. This sounds backwards. It sounds like something a conservative investor would say, not a trader. But the math doesn't care what sounds exciting. The math only cares what survives, and over any meaningful period of time, small consistent gains will always destroy large inconsistent ones. This isn't about being cautious. It's not about playing it safe or thinking small. This is about understanding how money actually grows in a probabilistic environment. You don't build wealth in trading by hitting home runs. You build it by staying in the game long enough for compounding to take over. And compounding only works if you never give it back. Every time you take a large loss, you reset the compounding process. You go back to the beginning. You're not just losing money, you're losing time. You're losing momentum. You're losing the geometric growth that only happens when gains stack on top of gains without major interruptions. The traders who understand this don't size their trades based on conviction. They size their trades based on survival, and survival is what unlocks compounding. Here's the logic you can't escape. Let's say you start with $10,000. If you make 10% in a month, you're at $11,000. If you make another 10% the next month, you're not at $12,000. You're at $12,100. That extra $100 is compounding. It's gain on top of gain. Now imagine you do this for 12 months, 10% every single month. You don't end the year at $22,000. You end at $31,384. You more than tripled your account. That's compounding. But here's the problem. This only works if you never have a catastrophic loss. If in month 6 you lose 50%, you're back down to $15,000. Now you need to make 107% just to get back to where you were before the loss. You just erased 6 months of progress. The compounding stopped. And starting over is the most expensive thing you can do in trading. Now compare that to someone who's aggressive. They make 20% 1 month. They lose 15% the next month. They make 25%. Then they lose 30%. At the end of the year, their account is barely up. Maybe it's flat. Maybe it's down. They had some huge wins. They felt like they were killing it during the good months. But the losses erased everything. There was no compounding because there was no consistency. And without compounding, you're just grinding. You're working hard and going nowhere. The aggressive trader looks exciting on any individual trade. But over a year, over 5 years, over a career, they get destroyed by the boring trader who just chips away at small, repeatable gains and never gives them back. George Soros is famous for breaking the Bank of England. He made over $1 billion on a single trade. Everyone knows that story. But what most people don't know is how Soros actually managed money over decades. He didn't bet the farm on every trade. The Bank of England trade was an outlier, a rare moment of asymmetric opportunity with limited downside. The majority of his career was built on small, consistent edge executed with obsessive risk management. His fund's annual returns weren't built on massive home runs every year. They were built on compounding mid-single-digit monthly gains without ever having a year that destroyed the progress. That's the part nobody talks about, the boring part, the part that actually made him billions, not the one flashy trade, the decades of discipline that came before and after it. This is where your brain works against you. Your brain is wired to respond to immediate rewards. When you make a big gain, your brain releases dopamine. You feel amazing. You feel validated. You feel like you figured it out. That feeling is addictive. So you start chasing it. You start sizing up because you want that feeling again. But dopamine doesn't care about your long-term success. Dopamine cares about right now. And what feels good right now is often exactly what destroys you over time. The trader who makes 5% in a week doesn't get the same dopamine hit as the trader who makes 20%. So the 5% trader feels like they're losing, even though they're winning, even though they're on the path to compounding. Their brain is telling them they're being too conservative. And that voice is incredibly hard to ignore. On the flip side, when you take a big loss, your brain doesn't just register the financial damage. It registers emotional pain. And your brain's response to pain is to do whatever it takes to make the pain stop. That's why traders revenge trade. That's why they double down. That's why they move stops. They're not trying to make money. They're trying to make the pain go away. And the bigger the position size, the more intense the pain, the worse the decisions. This is not a weakness. This is neurochemistry. You can't think your way out of it with discipline alone. The only way to manage it is to structure your trading so that losses don't create emotional crises. And the only way to do that is to keep position sizes small enough that your brain stays calm. Let me show you 2 traders over 3 years. Trader A and Trader B. Both start with $25,000. Trader A targets 15% per month. High conviction, big position sizes. When he wins big. Trader B targets 3% per month. Small positions, boring execution. In year 1, Trader A has an incredible start. He's up 60% in the first 4 months. He's at $40,000. He feels unstoppable. Then he hits a bad streak. He loses 25%. Then another 15%. He ends the year up 18%. Not bad. He's at 29,500. Trader B has a quiet year. He makes 3% most months, a few break-even months, one small losing month. He ends the year up 30%. He's at 32,500. Trader B is ahead, but Trader A doesn't care. He's convinced his big months prove he has more edge. Year 2. Trader A starts strong again. He doubles down on his approach. He's up 70% in 6 months. He's at 50,000. He's telling everyone he's figured it out. Then the market shifts. Volatility spikes. His strategy stops working. He loses 40% over 2 months. Then he tries to recover aggressively and loses another 20%. He ends year 2 at 28,000. He's now below where he started 2 years ago. He's mentally exhausted. He's questioning everything. Trader B has another steady year. 3% most months. A couple losing months where he's down 2%. He ends the year up 32%. He's now at 42,900. He's nearly doubled his account in 2 years. Trader A has gone nowhere. Same market, same time period. Different approach. Year 3. Trader A is burned out. He's trading emotionally. He's taking bigger risks, trying to get back to his peak. He has a terrible year. He's down 15%. He ends at 23,800. He's now below his starting capital. After 3 years of hard work, he quits. He tells himself trading doesn't work. Trader B has another calm year. 35%. He ends at 57,900. He's more than doubled his starting capital. And here's the critical part. He's not stressed. He's sleeping fine. His relationships are intact. He's still enjoying trading. He's positioned to do this for the next 20 years. That's compounding. That's what small, consistent gains create. Not just money, but sustainability, longevity, a career. Now take this into a real scenario. March 2020, COVID crashes the market. The S&P drops 34% in a month. Every strategy breaks. Correlations go to 1. Nothing works the way it's supposed to. If you were aggressive, if you were over-leveraged, if you were trying to hit home runs, you got destroyed. Not because you were a bad trader, but because the market doesn't care about your plan. It will test your structure. And if your structure can't survive chaos, you're done. The traders who survived March 2020 weren't the ones who predicted it. They were the ones whose position sizing allowed them to take the hits and keep going. They stayed small. They stayed flexible. When their equity curve dropped 15 or 20%, it hurt. But it didn't kill them. They were still there in April. Still there in May. Still there to participate in the recovery. And by the end of the year, they were fine. This is what professionals actually do. Institutional traders aren't swinging for the fences. They're grinding out small, repeatable edge. Renaissance Technologies, one of the most successful hedge funds in history, has averaged around 40% annual returns over decades. That sounds insane, but break it down. 40% annually is about 2.8% per month. That's it. Less than 3% per month compounded over years becomes generational wealth. They're not making 20% a month and then losing 15%. They're making small gains consistently and protecting against large losses obsessively. That's the entire model. Consistency plus compounding. No heroics, no gambling, just math playing out over time. Retail traders see this as boring. They think they need to beat the market by huge margins to make trading worth it. But that's ego talking. That's not math. If you can make 3% a month consistently, you double your account every 2 years. Do that for 10 years and you turn 25,000 into over 600,000. Do it for 15 years and you're over 4 million. That's not theory. That's just compounding. But it only works if you never have a year where you lose 40%. It only works if you protect the downside so aggressively that compounding never gets interrupted. And the only way to do that is small position sizes, small gains, relentless consistency. Here's what people miss. Large losses don't just hurt your account, they destroy time. Time is the variable that makes compounding possible. If you lose 2 years of progress because you got aggressive and blew up, you didn't just lose money. You lost 2 years of compounding. 2 years you can never get back. If you're 35 and you want to retire from trading at 50, you have 15 years. If you lose 2 of those years recovering from a massive drawdown, you now have 13. That's 13% of your compounding window gone, forever. The aggressive trader thinks they're maximizing opportunity, but they're actually minimizing time. And time is the only thing that turns small edge into life-changing wealth. So here's the shift. Building a big account is not about making big trades. It's about making small trades that you never have to give back. It's about structuring your trading so that your equity curve only moves in one direction over time. Up, slowly, steadily, boringly. The traders who get rich in the markets are not the ones with the best month. They're the ones who are still compounding in year 10 when everyone else has quit. They didn't win by being aggressive. They won by being structurally sound, by understanding that consistency beats intensity, that survival beats heroics, that compounding beats everything. You can't shortcut compounding. You can't force it. You can only create the conditions for it. And those conditions are simple. Small position sizes, consistent execution, protection against catastrophic loss, no interruptions. That's it. It's not exciting. It doesn't feel like winning in the moment. But 5 years from now, when your account is 10 times larger and you're still calm and still trading and still compounding, you'll understand. The best trades you ever made weren't the ones that felt the biggest. They were the ones that were small enough to repeat forever.